Hello, I'm James Timpson. I'm a fund manager at Courtiers. It's been another eventful year in markets, so I'm going to try and make sense of it by counting down the 5 biggest talking points affecting markets this year. So we start at number 5, the recession that never was. Making any kind of forecast regarding the economy or the stock market is a tricky business, and economists are almost always wrong. I found this nice quote from Ezra Solomon, who said, "The only function of economic forecasting is to make astrology look respectable." Someone who learned this the hard way was an economist at Yale University called Irving Fisher, who was around in the 1920s. Now, this is the Dow Jones Index, which tracks the US stock market, and as you can see, by the late 1920s, it was doing incredibly well. The stock market was absolutely booming. Then along came Irving Fisher, who famously said, stock prices have reached a permanently high plateau, implying that stocks were going to remain at these elevated levels for the foreseeable future. Care to guess what happened next? The Wall Street crash. Over the next couple of years, stock values crashed and lost almost 90%. And poor Irving Fisher was never able to recover his reputation. Fast forward to October last year, when Bloomberg published this article. Forecast for US recession within year hits 100% in blow to Biden. What the article says is that according to Bloomberg's economic forecasting model, which uses a range of macroeconomic and financial indicators, there is a 100% chance that the US will enter into a recession by October 2023. Presumably, everyone here remembers that happening, right? Well, the official definition of a recession is 2 consecutive quarters of negative GDP growth. So let's see what US GDP has done in the last year. It's been consistently positive. The US has not entered into a recession, so that 100% prediction made by Bloomberg's model turned out to be false. It shows that even the most advanced economic models can make supposedly 100% predictions inaccurate. On to number 4, and it was bound to come up at some point, it's inflation. And here it is, the UK Consumer Prices Index. And you may remember this time last year, it had reached a 41-year high of 11.1%. Thankfully, it's been coming down since then, and the most recent data from the ONS shows inflation at 4.6%. But this is still well above that fabled 2% target set by the Bank of England. So the Bank of England has continued to increase interest rates. In fact, over the last 2 years, the bank has increased the UK's base rate 14 times. And inflation and interest rates do tend to have a big impact on the stock market, particularly in the last year. Whenever the ONS has published its monthly inflation data, normally around the 3rd Wednesday of each month, it always seems that markets have been a bit more volatile. So I thought I'd look into this and see if that really was the case. Here we've got the average daily movement of the stock market on days when there's been no inflation data in yellow versus days when there has been inflation data in orange. So on average, the FTSE 100 has moved about 0.5%, either up or down on average this year. But on days when inflation has come out, surprise, surprise, the move has been bigger. The effect is even more pronounced on the FTSE 250 index, which tracks medium companies in the UK. On days when inflation data has come out, this index has moved on average more than 1%, either up or down, depending on whether it's good news or bad news. So inflation is clearly having a big impact on markets at the moment. And because inflation is still such a big talking point, it's the perfect excuse to bring back the inflation basket game. Each year, the ONS adds and removes items from its basket of goods and services which it uses to track inflation. I'm going to put some items on the screen now. Can you guess whether these items are in or out of the basket this year? So we start, of course, with tortilla wraps. Are they in or out? These are in. According to the ONS, bread products were underrepresented in the basket, so they've decided to add these. Incidentally, most bread products have gone up in price this year, but tortillas have stayed flat. We move on to frozen berries. Are they in or out? These are in due to increased health awareness and rising popularity of homemade smoothies. Next, we've got DVD box sets, specifically bought in store. Are these in or out? Out. These are out, purely due to declining popularity. Next, we've got home security cameras. Are they in or out? In. These are in due to increased expenditure on home security, particularly doorbell cameras, and also to keep the basket up to date with the latest smart technology. Next, we have super king-size cigarettes. Are they in or out? Out. These are out, simply because they're the least popular cigarette item within the basket. And finally, we've got mouthwash. Is that in or out? This is in. It's been brought in to expand the range of chemists' goods within the basket. Although it seems a bit pointless bringing in mouthwash now that they've just got rid of the king-size cigarettes. So there we have it. Who knows, maybe inflation won't even make the top 5 next year. That might be wishful thinking on my part. On to number 3, and we're breaking the banks. You may remember back in March this year, there was an awful lot of fuss about banks. And it all kick-started with the demise of Silicon Valley Bank, or SVB, a regional bank in California. So what happened? Well, SVB's client base is very heavily tech-orientated, with a lot of tech firms and tech startups. During the first year of the pandemic, SVB's deposits doubled, as these tech clients did very well. Unfortunately, SVB invested a large amount of this money in long-dated US Treasuries. And you may recall last year, US Treasuries got absolutely hammered due to rapidly rising interest rates. To make matters worse, SVB faced a bank run, with lots of clients wanting to withdraw their money at the same time. SVB was forced to sell lots of its assets at severely reduced prices, and this ultimately led to its collapse in March this year. And this sent shockwaves across the market, particularly the banking sector. So the hardest hit were the other regional banks in the US. But even the nationwide banks, such as Citi and Wells Fargo, they also took a hit. And it wasn't just in the US, but banking stocks in Europe and here in the UK. In fact, banking stocks everywhere were tumbling due to fears that we could be about to enter into another banking crisis. And SVB wasn't the only victim. First Republic Bank also collapsed, as did Signature Bank. And in Europe, Credit Suisse had to be rescued by UBS Group. So clearly, 2023 has been a big year for banking failures, but where does it rank in recent history? Well, this chart shows the number of bank failures in the US each year over the last 2 decades. And as you can see, there were loads and loads of them during the global financial crisis. This year, though, there have only been 4. So you may look at this and think, well, what has all the fuss been about? Well, if we add another line to this chart, showing the total assets attributed to each of these failed banks, we get this. Those 4 banks alone were worth over $500 billion. That's more than all of the banks that collapsed in 2008. It just so happens that SVB, First Republic and Signature Bank are 3 of the biggest banking failures ever in history. That's why markets were so shaken by their demise. Now, thankfully, things have calmed down since then. There was no major banking crisis, and most of those stocks have at least partially recovered some of their losses from March. Number 2 now, and it's time for the Magnificent 7. And no, sadly, I'm not talking about the 1960 Western thriller starring Yul Brynner, Steve McQueen, Horst Schultz, Charles Bronson, Robert Vaughn, Brad Dexter, and James Coburn. No, this is the name given to the 7 stocks that have taken the market by storm this year, largely due to the rise of AI, artificial intelligence. And you'll be familiar with these by now. And in reverse order of how well they've done this year, we've got Tesla, we've got Apple, we've got Alphabet, aka Google, there's Microsoft and Amazon, and then there's a big leap up to the 2 leading stars. We've got Meta, formerly Facebook, that's up 172% this year. And can you guess which logo is about to replace Yul Brynner here? It's NVIDIA, up 176% this year. Now, NVIDIA is a leading manufacturer of AI hardware and software, so clearly it's had a good year. And in fact, in May, it became only the 9th company ever to reach a valuation of $1 trillion. Now, the AI frenzy that we've seen this year has at least partly been driven by the surge in popularity of something called ChatGPT. Now, I'm by no means an expert in how this sort of thing works, but ChatGPT is essentially a chatbot. You can ask it questions, you can ask it to write things, and within seconds, it will come back with a detailed and normally very accurate response. Now, ChatGPT was released by OpenAI in November last year, and by January, it had become the fastest growing consumer software application ever, with over 100 million users. So the other day, I thought I'd see what all the fuss was about, so I decided to set up an account with ChatGPT. The first thing I asked it was this: "Hi ChatGPT, please tell me a joke about investing." And in just 2 seconds, ChatGPT replied, "Why did the investor bring a ladder to the stock market?" Because he wanted to take his portfolio to the next level. So straight away I fell in love. I thought, this is brilliant, I'm loving this. So I replied, LOL. ChatGPT came back, "I'm glad you enjoyed it. If you have any more requests, or if there's anything else I can help you with, feel free to let me know." So I thought for a minute, and I thought, well, hang on, I've got a deadline approaching here. I'm going to try my luck. So I went back with, "Please can you write a 15-minute presentation on this year's financial markets suitable for a client seminar, preferably with some light-hearted moments and maybe the odd joke or two." And amazingly, in just 2 seconds, ChatGPT came back with, "Write it yourself, you lazy sod." I haven't spoken to it since. So with that, I think we should just move on to number 1, and it's something that everyone's been searching for since, well, the outbreak of the pandemic, really. It's light at the end of the tunnel. It's fair to say that markets have been through a lot in the last few years, and although this has been a good year for the likes of the Magnificent Seven, for everything else, it's been a slightly different story. Here we've got an overview of how markets and asset classes have done in the last year. And on the left there, you've got the S&P 500. Now this tracks the US stock market, so it's clearly dominated by those big 7 companies, and that's why it's had such a good year. But for everything else, it's been much more of a struggle. In fact, this has been one of those very rare years where cash has actually been one of the best performing asset classes. FTSE 100 has just about scraped a positive return. The FTSE 250 is down. Commodities are down. Gilts and fixed income are down due to interest rates continuing to rise. Foreign currencies are down versus the pound, so major currencies such as the dollar and the yen. So even though it's actually been quite a good year for US equities and Japan equities, those returns to us, as sterling-based investors, have been eroded by the currency depreciation. And perhaps the biggest upset of all, infrastructure funds, normally such a reliable performer. But they, along with investment trusts in general, have really struggled this year due to uncertainty over how high rates might go, how long they might stay high, and how this will affect the discount rate used in valuing their assets. So Magnificent Seven aside, it's been quite a challenging year. Which brings us on to fund performance. This is the Courtiers fund performance over the last 12 months. So the cautious risk fund is down 2.47%, the balanced risk fund is down 2.12%, and the growth fund is down 1.98%. And we do have this slightly bizarre anomaly where the cautious fund has lost slightly more than the growth fund. This is simply because the cautious fund, being capped at 60% equities, invests more in other asset classes such as fixed income and infrastructure, which are typically less volatile than equities. But as we've just seen, while it's been an okay year for equities, gilts and infrastructure have found it much more challenging this year. So we have this very rare and atypical example of the cautious fund underperforming the growth fund. But I did call this segment light at the end of the tunnel. As we saw earlier, inflation has been coming down fast. interest rate hikes have slowed down in the last few months, both here and in the US. And the most recent PMI data, which shows the strength of UK manufacturing, that came in stronger than expected a few weeks ago, which is an encouraging sign for the UK economy. There's one other thing I want to show you, and that's market volatility. You may recognise this chart from the last few seminars. It shows the number of times each year that the global stock market has moved more than 2%, either up or down, in a single day. So in 2020, the year of the pandemic, it happened 40 times. It happened a lot last year as well, but do you care to guess how many times it's happened this year? Well, believe it or not, it's happened 0 times. There have been big market swings this year, both up and down, but they've been fairly gradual swings. So instead of the market losing 5% in a day, it's lost, for example, 1% a day over the course of a week. But it means that volatility has actually been a lot lower than you'd think. And that's really good news, because it means that option prices have just become affordable again. And over the last couple of months, we've actually been able to buy call options on the FTSE 100 in place of futures, which gives us a layer of protection in the funds, something we haven't been able to get since before the pandemic, as option prices have been so high. So having these call options in the fund, as well as lots of really attractively valued assets, means that actually now is a really exciting time to be an investor. Now, earlier this year, I celebrated my 10th anniversary at Courtiers. That's right, I've been working with Gary and the investment team now for over 10 years. It's fair to say that I know a lot more about rugby than I did 10 years ago, and a lot less about getting a good night's sleep. But it's been an eventful 10 years, so for this year's Play Your Markets Right, I thought we'd look at some market returns from the very day I joined Courtiers back in June 2013. And do you know how it works by now? I'm going to show you some market returns. Can you tell me whether the next one is going to be higher or lower than the previous one? So we start with European equities. These have returned 107% over the last 10 years. But what about US equities? Are they higher or lower? Higher. These are higher. The US has been the place to be over the last 10 years, having returned an incredible 242%. Next, we've got Chinese equities. Higher or lower than the US? These are lower. Chinese stocks have only returned 31% in the last 10 years. Next, we've got the gold price. Is that higher or lower than 31%? Higher. This is higher. The price of gold has appreciated 46% since 2013. Next, we've got pound sterling versus the dollar. Is that higher or lower than 46? This is lower. The pound has depreciated 20% against the dollar in the last 10 years. So what about Bitcoin? Is that higher or lower than -20? Higher. This is ever so slightly higher. Bitcoin has gone up 38,179%, but that is down from about 70,000% 2 years ago, so it's not really that good. Next, we've got UK gilts or government bonds, higher or lower than 38,000. No prizes for this one, it's lower. UK gilts have only returned 3% in the last 10 years. So what about UK equities? The good old FTSE 100, is that higher or lower than 3%? Higher. This is higher. It's actually been quite a good period for UK equities. They've returned 76%. And last up, we've got the Courtiers Growth Fund. Is that higher or lower than 76%? Higher. Let's be honest, would I have really put this here if it was lower? Of course I wouldn't. It's higher and returned 129%. And here's how all three of the Courtiers funds have done in the last 10 years. The Cautious Fund has returned 60%, the Balanced Fund has returned 95%, and the Growth Fund has returned 129%. And this is despite all of the market turmoil that we've seen, particularly in the last few years. So we're really pleased with how the funds have done in the last 10 years. So there we have it. I wish you all a wonderful Christmas and New Year. I'd just like to say it's been a pleasure to have been a part of looking after your money over the last 10 years, and here's to 10 more.